Okay, so let's talk about how I earned $100,000 completely tax-free. And no, I'm not talking about some illegal way or like weird system strategy. I'm literally talking about the rules and laws that are written in the tax code and how I was able to take advantage of it to earn 100 grand completely tax-free. Now, for those of you who are new to my channel, welcome. My name is Sean. I am a real estate investor and flipper. I have invested in over 20 rental properties and property flips. I am also a life coach. I help people create breakthroughs in the areas that matter most to them in terms of their finances and their fitness, helping people live life on their terms. Now, if you are into finance videos, living life in your terms, financial freedom, then I would highly suggest after this video, make sure you check out some of my other videos where I talk about some awesome strategies. So make sure you do that. I'll also leave some links to other videos that you may enjoy in the description box below. As we get started, if you would do me a solid, hit the like button, hit the subscribe button as well, and that little notification bell, and let's just jump right into it. Now, while this video is not about an in-depth look into taxes, it's important to understand that taxes are by far one of the biggest expenses that we have in life. And while it is important to pay taxes, you should not be overpaying in taxes. And so let's talk about why this is such a big deal. Let's use an example. Let's say that you are 30 years old and you make $100,000 a year. So you're doing really, really great. You're crushing it. 30 years old, $100,000 a year. And let's say you're paying right now around 30% in taxes, meaning that $30,000 of that $100,000 is going to Uncle Sam. But let's say that this one particular year, you managed to find a way to earn $100,000 and pay zero taxes on that money. And you take that $30,000 and instead of spending it, you decide that you're going to invest that money in an S&P 500 index fund, and it averages about 10% from the age of 30 to 65. So let's say that you didn't put any more money in. You took that $30,000 at the age of 30, you put it into a fund, and without ever putting any more money into it, you let it sit from the age 30 to the age of 65, and it averaged 10%. Which is what the average return has been for the S&P 500. How much money do you think you would have? 50,000, 100,000? Wait for it. Just shy of $1 million. And imagine if you were able to take that system every single year and keep doing the same thing, imagine how much more money you'd have because you have not been paying in taxes. Now, like I said, this is not to say you should never pay taxes. This is just to say that taxes are a major thing and they are a huge expense, and we have to figure out how do we lower our tax rate so that we can continue to build at compound interest, build wealth for ourselves and financial freedom. So let me share with you how I was able to do it this past year utilizing real estate. So the way in which I was able to make $100,000 completely tax-free was through two different rental property acquisitions. Now, the first one was a single family home that I got as a foreclosure. It was a 2-bed, 1-bath, and I was able to buy it for $19,000. Now, what I did to buy this one was I actually went to a bank and got a personal loan for around $25,000 at about 5.5% interest for about 5 years. And then after I purchased the house with that loan, I used about, $18,000, $19,000 of my own personal money to add in an extra bedroom, an extra half bath. And then I also did a few other things too, like fixing some of the flooring, repainting, and doing a few other cosmetic things to help drive up the value of the home. Now, in addition to the single family home, another acquisition that I did was with a 3-unit building. This had 2 1-bed, 1-bath units, and then also a 2-bed, 1-bath unit. Now, I was able to purchase this property for $55,000, and I had to put about another $5,000 to $6,000 into it, replacing a water heater, putting in a little bit of new flooring, doing some painting, and things like that. So all in all, my total investment was somewhere around $80,000 of my own personal cash. Now, once I had both these properties fully rented out, fully renovated, ready to go, I then went to the bank and said, hey, I want to do a refinance. I want to take out some of my money because I didn't want all my capital sitting in this property. I wanted to take my money back and I wanted to get more income coming in from more acquisitions. So after I did that, I did an appraisal on the homes, and sure enough, that single family home that I bought for $19,000 and put about $20,000, well, about $18,000, $19,000 of work in, was valued at around $75,000. That $55,000 multi-unit that I purchased, I put about another $5,000 in, was now worth $96,000. So the new appraisal for those two buildings was $171,000, and I had only invested about $80,000. So it's just shy of $100,000. So the real question becomes, how come you didn't pay any taxes on it then? Because if you earn money, you have to pay taxes. That is true. If you earn money, you have to pay taxes, but you do not pay taxes on debt. So let's rewind for just a second and talk about the two ways in which you typically pay taxes. Number one is on earned income. So if you have an hourly rate, or if you are salaried at your job, you're going to go there, you're going to work, you're going to earn money, you're going to pay taxes on that income, and then you spend what's left over. The other way in which you pay taxes is what's called capital gains. And that's when you buy something and sell it for a higher price later on. And the difference, or the profit that you make, you have to pay taxes on. So the question becomes, well, how come I didn't pay taxes if I bought the house for, for a certain price and sold it for more? How come I didn't pay taxes on it? Well, I would have paid taxes if I sold the house. You see, if I bought that $55,000 unit, put 5 into it, so I'm $60,000 in, and then I sold that thing for $96,000, I would have paid taxes on the difference. And the amount of tax I would have paid would have been based on how long I held it. Now, if you own something for less than a year and then you sell it, you pay an earned income rate. So you're going to pay the same tax rate that you do with your earned income. If you hold longer than 1 year, then you're going to pay a different tax rate. Now, we're not going to go into the details of that right now, but just know, typically if you buy something and then you sell it later for a higher price, you pay taxes. Now, here's the kicker. Here's how I did not pay taxes. You see, I didn't sell these properties. I went to the bank and I got what's called a line of credit, or I could have even done a refinance. And by doing that, I'm essentially taking out a loan on the equity or the value of that thing. You see, you don't pay taxes when you take on debt. And so what happened was, instead of me cashing out, taking the $100,000 and paying taxes on it, I took out a loan against the equity of it. And that $100,000, I'm paying a small interest rate, but now I can use that $100,000 to buy the next property and do the same thing. This is absolutely huge, because once again, had I earned $100,000 in income and had to pay, let's say, 30% taxes on it, well, guess what? That would have been $30,000 out of my pocket that I could not have used. All these fees compound over time. So it's super, super important that as you begin to earn more money, as you begin to build your wealth, you got to start finding ways of alleviating your tax liability, because that is another way of really magnifying your wealth. Anyways, I hope that made sense to you. If you haven't done so already, smash that like button, hit the subscribe button for me, and make sure you check out some of my other videos. Let's get out there and let's crush it.